Imagine walking into a casino where you're guaranteed an 8% payout every year, and you still get to keep playing. That's essentially what STRK or STRK offers. But unlike a regular casino, the house, aka Microstrategy, holds a massive Bitcoin stack. That sounds like a winning hand, right? But here's the real question. Can STRK actually survive a Bitcoin crash? Because if history tells us anything, this might not end well. STRK looks like the ultimate Bitcoin investor's dream. 8% dividends and exposure to Bitcoin's upside. But can Microstrategy actually afford to pay that yield long term? Bitcoin's past cycles have had huge booms followed by brutal crashes. And unlike traditional dividend stocks backed by stable profits, STRK's payouts rely on one of the most volatile assets in history. So what happens when the next bear market hits? Does STRK survive or does it collapse? Before you invest, here's what you need to know. What is STRK and how does it work? Dividend stocks are supposed to be stable, but STRK, it's different. If you haven't turned on the news lately, STRK is MicroStrategy's latest move, a Bitcoin-backed preferred stock that pays an 8% dividend. Instead of just holding Bitcoin and waiting for the price to increase, investors get cash flow while staying exposed to Bitcoin's price movements. At a glance, STRK looks like the best of both worlds. But before you rush in, let's break it down because there's more to the story. MicroStrategy was once a business intelligence company. Today, it's the largest corporate holder of Bitcoin, with over 470,000 Bitcoin worth $20 billion. Since 2020, its stock has moved almost 1-to-1 with Bitcoin, fueled by Michael Saylor's choice for aggressive debt financing and equity sale to buy more Bitcoin. Now, with STRK, MicroStrategy is creating a new way for investors to bet on Bitcoin without buying it directly. So how does STRK work? Well, it's a preferred stock that pays an 8% annual dividend, far higher than traditional dividend stocks, and I'll come back to this shortly. It's indirectly tied to Bitcoin, which means that the yields depend on MicroStrategy's ability to manage its Bitcoin holdings. It offers conversion to MSTR, MicroStrategy stock, which could dilute existing shareholders over time. This makes STRK unique. Holding Bitcoin alone doesn't pay dividends. MSTR stock moves with Bitcoin, but it doesn't offer yield. STRK, however, pays you to stay in the game, but dividends don't appear out of thin air. Before we go there, you guys know I love looking at patterns across history. So let's look at 2 historical warning signs. Number 1, Bitcoin mining stocks. During Bitcoin's last bull run, mining companies like Core Scientific and Riot Blockchain saw their stock prices skyrocket past 60K. To attract investors, some miners offered dividends based on their high profits from mining Bitcoin at premium prices. Seemed like a great deal. Steady cash flow plus Bitcoin upside. But when the bear market hit, Bitcoin's price plunged 77% from its all-time high, which it does. Suddenly, mining profitability collapsed and those dividend payouts became unsustainable. Core Scientific, once a multi-billion-dollar company, filed for bankruptcy in 2022 after struggling with debt, energy costs, and declining Bitcoin revenue. Other mining firms like Hut 8 and Marathon Digital had to cut costs, scale back operations, and eliminate dividends just to survive. So you can see that a high dividend yield is only as good as the company's ability to sustain it, especially in volatile markets. Now, STRK, like these miners, is heavily tied to Bitcoin's price. If Bitcoin crashes, can MicroStrategy keep paying 8%? 2008 financial crisis. Another really telling example is what happened in 2008. Before the financial crisis, big banks like Citigroup, Bank of America, Wachovia, remember them? They paid massive dividends, luring investors into what seemed like safe, high-yield plays. These companies were financial giants. They were too big to fail, or so investors thought. Then the subprime mortgage bubble popped. Liquidity or cash dried up. Bad loans piled up and banks faced mountains of losses. Dividend payments became unsustainable overnight and banks slashed payouts to near zero. Citigroup cut its dividend 97% before taking a government bailout in 2008. Bank of America dropped its dividend from 64 cents to 1 cent per share as losses mounted. Lehman Brothers never even got the chance. It collapsed entirely, marking the largest bankruptcy in US history. Investors who chased high yields without understanding the underlying risks lost everything. Why this matters for STRK? Strike's 8% yield isn't backed by traditional revenue streams. Unlike companies that fund dividends through consistent business profit, Strike relies on Microstrategy's ability to navigate Bitcoin's volatility, debt, and investor sentiment. And if history has taught us anything, from the Bitcoin miner collapse of 22 to the bank dividend cuts of 08, high yield can vanish overnight if the underlying asset crumbles. The real question isn't just how high Strike can go, but whether it can survive when Bitcoin isn't booming. Where does the money come from? Strike's dividend isn't powered by steady cash flow like Coca-Cola or Johnson & Johnson. Instead, it depends on three key sources. Number one, Microstrategy's Bitcoin holding. If Bitcoin rises, Strike benefits. But if Bitcoin crashes below Microstrategy's average buy price of 65,000, things get risky fast. Two, capital markets. Microstrategy has a track record of issuing debt and equity to fuel its Bitcoin purchases. This works in bull markets, but if liquidity dries up, it could impact Strike's sustainability. Three, investor conversions. Strike holders can convert their shares into MSTR stock, which might seem like a perk. It also introduces dilution concerns, which bring us back to the big question. What happens when Bitcoin isn't booming? So what's the catch? Strike is an innovative, high-yield Bitcoin play, but it comes with serious risk. If Bitcoin keeps rising, Strike could thrive. But if history repeats itself, those dividends and the stock price could face major pressure. And that's what we're getting into next. Could Strike actually explode as Bitcoin surges in 2025? Or is there a hidden downside waiting to catch investors off guard? The bull case. Why Strike could surge to the moon, baby. First, let's talk about the upside, because Strike isn't just another dividend stock. It has one huge advantage that traditional dividend players like Coca-Cola and Johnson & Johnson don't have. It's directly tied to Bitcoin. And if you've been paying attention to Bitcoin's price cycles, you know that we're heading into one of the most explosive phases in crypto history. And if you don't know crypto history, or if you just feel overwhelmed, I have a completely free money and crypto master course down below. It's free as of right now. At some point I'm gonna charge because it's worth a lot. It's 15 years of me pouring in everything I have self-studied, I've experienced, I know about money and crypto so that you don't have to get screwed over and caught off guard by what's happening in this world. So grab that course and let's keep going. The Bitcoin bull run catalyst. Historically, Bitcoin follows a 4-year cycle, driven by the Bitcoin halving, which has happened in April of 24. If history repeats itself, this means Bitcoin could see massive price appreciation this year and possibly even in 2026. So take a look at previous bull run cycles. 2012 halving to Bitcoin surging 9,000% in the following year. 2016 halving, Bitcoin rose 2,800% within 18 months. 2020 halving, Bitcoin climbed over 700% before peaking at 69,000 in 21. Now, with institutional demand ramping up, including Bitcoin ETFs and companies like BlackRock entering this space, analysts believe this could be the biggest bull run yet. Bloomberg Intelligence Mike McGlone suggests that Bitcoin could reach 150 or even 200,000 in this next cycle. If that happens, Strike is positioned to explode, not only because of its dividend appeal, but because its underlying Bitcoin holdings will become significantly more valuable. And here's where things get really interesting. Strike could benefit more than Microstrategy stock, MSTR. Now, Microstrategy, or MSTR, has already been one of the biggest beneficiaries of Bitcoin's rise. Its stock has moved in near perfect correlation with Bitcoin, and it has outperformed even Bitcoin in some cases. But Strike, it has an extra layer of appeal. It offers passive income. While MSTR holders only profit when the stock appreciates, Strike holders earn 8% annual dividends, making it far more attractive to investors who want both Bitcoin exposure and cash flow. It could attract a new class of investors. Right now, most Bitcoin-related stocks are either high-risk growth plays like Coinbase or traditional mining stocks like Riot and Marathon. Strike fills a gap. It offers Bitcoin exposure with the kind of stability that dividend investors love. More institutional interest. Dividend stocks tend to attract institutional capital, including pension funds, insurance companies, and sovereign wealth funds, institutions that wouldn't normally invest in crypto or volatile Bitcoin stocks. Strike could be their way in. In other words, Strike could pull in a different kind of investor, one that isn't looking for high stakes, high risk world that Bitcoin offers, but instead wants a steady, predictable return while still benefiting from Bitcoin's long-term upside. The dividend is the game changer. The biggest selling point on Strike is its 8% dividend a year. Think about it. Most dividend stocks like Coca-Cola, Johnson & Johnson, they 2 to 4%. But Strike is offering over double that, while also being tied to Bitcoin's growth. This makes Strike one of the highest yielding stocks in the market, while still offering the potential for major upside if Bitcoin surges. Bitcoin's ETF boom could push Strike higher. Here's another wild card: Bitcoin ETFs. Now that spot Bitcoin ETFs have been approved, major players like BlackRock, Fidelity, ARK Investments, they're scooping up huge amounts of Bitcoin. According to crypto analyst Will Clemente, institutional demand for Bitcoin could create a supply shock, pushing Bitcoin way past 100,000 sooner than expected. I mean, it already did, but what it would do is stabilize. It creates a new floor. And if that happens, Strike's underlying Bitcoin holdings become more valuable and the stock becomes more attractive. So here's the bottom line. Bitcoin is set up for a bull run in 25 and 6. Strike offers Bitcoin exposure and an 8% yield. Institutional investors might jump in, creating additional demand. But before you rush to buy Strike, there's a major risk that could crush its long-term value. And that's what we're going to tackle next. The risks. What could go wrong, right? While the upside's exciting, there are real concerns that could make Strike a volatile investment, especially in the long run. Number one, Bitcoin's boom and bust cycle. Strike is fundamentally tied to Bitcoin, which means when Bitcoin surges, Strike thrives. But what happens when Bitcoin crashes? The 4-year Bitcoin cycle shows that massive bull runs always followed by painful bear markets. 2013 to 14, Bitcoin soared from $13 to $1,100, then crashed 80%. 2017 to 18, Bitcoin peaked at 20,000, then dropped 84%. 21 to 22, Bitcoin hit 69,000, then collapsed 77%. If history repeats itself, we can easily see Bitcoin climbing over 200, 300, even up to 500,000 in this cycle, but then plummeting down to 60, 50,000. We don't know for sure, so there is some risk. So this is where I believe the real question: how does Strike sustain its 8% dividend during Bitcoin's downturn come in? Can Strike maintain its 8% dividend in a bear market? The biggest concern with Strike is whether its dividend is sustainable. See, unlike traditional dividend stocks that generate consistent cash flow from stable businesses like Coca-Cola selling bevies or Apple selling iPhones, Strike's ability to pay dividends depends on Bitcoin's price remaining high. Microstrategy's strategy for managing Bitcoin's volatility. Well, right now, Strike's Bitcoin holdings are sitting in an average buy price of $65K per Bitcoin. So that's great if Bitcoin stays above that level. But what happens if Bitcoin drops to 50 or 40K or lower? And it could happen even momentarily. Well, at those prices, Strike could face serious cash flow issues, making it hard to maintain the 8% payout. If Strike has to cut or suspend dividends, it could trigger a major sell-off, sending the stock plummeting. So if you're buying Strike solely for the dividend, keep in mind that it's not guaranteed, especially when Bitcoin enters a bear phase. So could Strike face liquidity issues? Microstrategy has built its reputation on aggressively leveraging debt to buy more Bitcoin, a strategy that has worked so far but comes with serious risks. If Bitcoin's price crashes, MicroStrategy could struggle to maintain its debt obligations, which could create liquidity issues for Strike. Here's how this could play out. First, Bitcoin drops below 65K. Strike's balance sheet weakens. Second, MicroStrategy needs cash and might be forced to sell Bitcoin at low prices. Third, dividend payments come under pressure. Strike might have to cut or pause payouts. 4, stock prices tank. Dividend investors exit, creating a negative feedback loop. This isn't just speculation. It's already happened to Bitcoin mining companies like Core Scientific, which went bankrupt in 22 after failing to manage its debt in a Bitcoin downturn. Remember? So if Strike isn't careful, it could find itself in a very similar situation. Regulatory risk. Is Strike in the crosshairs? Another risk that can't be ignored is regulation. Right now, governments and regulatory bodies aren't too happy about Bitcoin-backed companies issuing high-yield dividends. Strike's structure is unprecedented, which means regulators might start asking some questions like, is Strike functioning as an unregistered ETF? Could it face restrictions similar to crypto-related stocks? What happens if the SEC tightens Dividends regulation on Bitcoin-backed stocks. Just look at what happened to Binance, Coinbase, and other crypto firms. Regulators have aggressively cracked down, forcing companies to adjust their business models. Now, I'll be the first to admit that right now the regulatory framework in the US looks very friendly towards crypto, but my role is to present more than just my opinion. And so that's what I'm giving you, so you have a full view of what the risks are. Risks that include, if it comes under scrutiny, it could face restrictions, lawsuits, or even forced changes to its dividend structure, any of which could negatively impact the stock. Competition. Will other companies copy Strike? Right now, Strike is unique. It's the only publicly traded stock that offers high-yield Bitcoin dividends. But that won't last forever. If Strike gains traction, what's stopping other companies, maybe even BlackRock, Fidelity, or ARK Investments, from launching a better version? Lower fees, more diversified Bitcoin holdings, higher yield with better stability. If that happens, Strike could lose its edge, making it less attractive to investors over time. So, should you buy Strike? Strike is one of the most exciting Bitcoin-related investment plays we've seen in a long time. I never tell you what to buy. This is not financial advice, but it is exciting, and it offers Bitcoin exposure with an 8% dividend. It's positioned to benefit Bitcoin's next bull cycle, and it fills a gap in the market for yield-seeking investors. But it also comes with some risks. Okay, Bitcoin's volatility could make dividend payments unsustainable. A deep bear market could force Strike to cut payouts. Regulatory pressures could impact the stock structure. Liquidity issues could emerge if Bitcoin crashes. So, is Strike worth buying? Well, if you believe in Bitcoin's long-term growth, and I do, and I can stomach potential dividend cuts during bear markets, Strike could be an interesting play. But if you're looking for a stable, low-risk dividend stock, this might not be the right fit. The next Bitcoin cycle will be a make or break moment for Strike. The question is, will it thrive or will it crash and burn? What are your thoughts? Drop them in the comments. I read them all. I personally reply to them. And if you haven't yet, smash that like. Be sure to subscribe for new videos every week. I value and appreciate you being here. I thank you for giving me your time. Here's a fist bump. Boom. From me to you, baby. Check out this next video. I will see you there. And until then, you keep living your life to the fullest. Peace.